Hi there, welcome to Kneppy Invest. There is one thing I've never done as an investor, and that is draw up a hit list or a group of companies that I am looking at buying when the share price falls a lot, when we see a major sell-off in the markets. And we might be seeing that right now. It's only a possibility. So I've decided to draw up a list of companies that I am willing to buy if I do see the share price fall by a fair bit. And in this video today, I'm going to give you 6 companies that are on the Nasdaq, and you won't be surprised about these 6 companies. Well, most of them anyway, because they are the largest companies in the world. And what I'm going to do is look at the chart and give a price target where I'll go all in. And I am exaggerating when I say go all in, because I won't go all in, but that's where I would be looking at seriously taking a position in these companies. Before I start talking about these 6 companies on the Nasdaq, just want to have a look at where the Nasdaq stands right now at the end of trading on February the 11th. I'm looking at the NDX here. And this goes back to the start of 2020. So this does include the COVID-19 panic, the COVID-19 cough, whatever you want to call it. And during that period, the Nasdaq actually fell 3,000 points. And then you can see a massive rally in the Nasdaq from the end of that panic all the way to the end of 2021. In fact, the Nasdaq rose from about 6,800 all the way to a high of 16,800. So a massive rise in the Nasdaq during that period. However, it has looked like the Nasdaq is starting to roll over. It has moved into a downtrend, and also sentiment has shifted to negative as well. We have seen a crossover between the 50-day and the 100-day moving averages, and that is one things I do look for with a possible shift in sentiment. And when you look at the total drop in the Nasdaq since its high, which was actually reached in November last year, it's actually fallen 3,000 points, which is the identical to what we saw during the COVID-19 financial panic. The only difference is, since the market has risen by a significant amount during the last 2 years, the percentage fall isn't quite what we did see in the COVID-19 financial panic. However, this is suggesting there is overall weakness in the market, and there are some companies who've seen their share price fall 60-70%, and potentially these companies are looking a lot more attractive. Unfortunately, the biggest and best and highest quality companies on the Nasdaq haven't fallen by that amount. They've actually just seen their share price starting to fall right now, and those are the companies I'll be focusing on this video, except for one, which I'll show you right at the end of this video. First company I'll look at is Alphabet, and this is a company I'm most definitely interested in taking a position in. And to be honest with you, I've only really started looking at buying into the American markets during the past year and becoming a little bit more seriously during the last 6 months. But with the overall weakness in the markets during the last, say, 3 or 4 months, I'm just going to be patient and just wait. And we have started to see Alphabet's share price trying to roll over, just like we're seeing in the overall market. They did release some really good quality results, and we saw the share price really pop up and reach an all-time high. But since that day, the share price has pulled back from about $3,050 all the way back to $26.82. And when you look at some of the valuation metrics, PE ratio of only 24, price operating cash flow of only 20, they are not too stretched for this company. Now, Alphabet is growing at a fairly good rate and has been growing for a long time, and who knows how long this growth will continue for. But PE ratio of 24, based off its historical range, what do you expect to see with this company, is not that high. So right now, there's probably some good value with Alphabet, but I'm hoping that this overall negative sentiment in the market will continue and the share price of Alphabet could fall all the way down to $2,000. And if it does go to $2,000, the PE ratio of Alphabet would be 17, and that would be historically cheap for this company. And I might go all in, even though I'm exaggerating when I say that, but I'll definitely take a significant position in this company if the share price does fall all the way down to $2,000. Now onto a company that has seen its valuation really climb over the past few years. And that is Nvidia. Now their PE ratio and price to operating cash flow both at 24, and they are at historical highs Well, not historical highs because the share price has dropped over the past few months. But when you look at a year-to-year basis, those valuation metrics are quite stretched for this company, even though it is growing. So even though the company's share price has moved into a downtrend, and we have seen share price fall from $350 to a current share price of $240, the company still looks expensive. And this is a problem with a lot of companies on the Nasdaq, apart from those really big companies that I'll be talking about in this video. A lot of these companies are not even profitable, not even operational cash flow positive, and there is a chance a lot of these companies have still a fair bit left to drop from here. And with Nvidia, I'm a little bit less confident, and so my all-in target with this company is at $80. And $80 would mean the PE ratio, price operating cash flow, would be between 20 and 30, which would make this company fair value. So if we do see Nvidia share price fall all the way down to $80, I think we'll see a massive correction, possibly even a bear market with the Nasdaq, and that will filter through to other exchanges around the world, including Australian exchanges. So at this point in time, my target for Nvidia is well off from where the share price is right now. So more than likely, this is the one company in this list I would not be making a purchase in the near future. Now, unlike Nvidia, Microsoft is not too expensive at current prices. PE ratio is at 31, price operating cash flow 27, and those are within historical ranges. But just like most other companies on the Nasdaq, the share price has been under pressure over the past few months. In fact, the share price has fallen from $350 to a current share price of $295. When it comes to my all-in target for Microsoft, I did have a range here, and that range was between about $220 and $190. So I've just decided to take the bottom price target in that range, which is $190. And the reason I chose $190 is with the latest financial data from this company, that would make the PE ratio of Microsoft drop below 20. And if the PE ratio of Microsoft gets below 20, that is almost an all-in price target. I would almost go all in with this company because I do think there is still significant growth ahead for this company. And with a PE ratio of less than 20, the market will be pricing in all that growth ahead. And I think the only way we're going to see $190 reach for Microsoft if, again, just like Nvidia, we see a massive correction in the market and potentially even a bear market. Now, I believe this is the biggest company in the world right now, Apple. $3 trillion market cap it did reach recently, but the share price has pulled away. But in saying all that, the share price is still in an uptrend. So unlike most other companies, the overall weakness in the market hasn't really affected Apple all too much. And when you look at the valuation metrics, P ratio of 28, price operating cash flow of 25, don't seem too large for this company. So this company has been growing and growing really well. There has been stages over the last 5 or 6 years where it doesn't grow all that much quarter on quarter. But if you take the whole period, the last 6 years, and look at the growth in this company, it has been really good. And it just continues to grow and grow and grow. There are some things I am a little bit concerned. These are slight concerns about this company in the future. And they're really not, those concerns don't belong in this video. But if I do see the share price of Apple for another 40, say 45 to about $55, that PE ratio would fall below 20, and that would make this company attractive again. Because back in 2016, when Buffett went, maybe not all in, but he did take a large position in this company, at that point in time, the PE ratio was quite low. I think it was like maybe 12 to 14. At that point in time, the market wasn't expecting significant growth in this company. And the market also viewed this company a little bit differently. It viewed this company as a hardware company, not as a software company, that sort of thing. So I think the market has changed its view of this company over the past 5 or 6 years. And that's why a PE ratio of, say, 18 is just as attractive as a PE ratio of this company when it was 12 or 14 back in 2016. Amazon is a company I've been following for about a year, but the share price has been going sideways during that period. So I've decided not to take a position in this company. In fact, the share price has been going sideways for about 18 months, up until recently, where we did see a little bit of weakness in the share price. It fell to about $2,700, which was about an 18-month low recently. Then they released their quarterly results, and the share price did rebound because the market did react to those quarterly results quite positively. Now, when it comes to the PE ratio and the price to operating cash flow, they do seem a little bit high. PE ratio of 47, but when you compare that to historical values, that is actually really low, and that means this company hasn't really focused on profitability. They're focused more on growth and operating cash flow, and even the price of operating cash flow at 34, with significant potential growth in this company over the next 5 to 10 years, particularly in the Amazon Web Services. That area does look attractive. So I think there is a bit of attractiveness right now with Amazon, and if the share price falls to about 2,200, which was a share price just before COVID-19 financial panic, that's when I'd probably take a serious position in this company. Most of the other companies I feature in this video, in fact, all the other 5 companies I feature in this video, I actually do follow quite closely. When it comes to PayPal, I have not really taken notice to how this company has performed financially or how the chart and share price has performed at all, up until I decided to choose not one company at random, but I just went through some of the charts for the other Nasdaq companies, and what drew me to PayPal is how the share price has really fallen off a cliff over the past 6 months. In fact, the share price reached a high of $300 in July last year. So that means the share price has fallen from $310 to a current share price of $115. So that's about a 60% drop in valuation of this company over a fairly short period of time. And you just see by looking at the chart how the share price has just fallen off a cliff. And looks like there could be some good news or bad news being released by the company, because we have seen some gaps. And when you see these big gaps in the share price from one day to the next, more than likely that is some bad news. So when I saw this chart, I just wanted to see if there was any possible value when it comes to PayPal. And I think there is potential value here for this company, but I have to do a little bit more research to see what caused these significant drops in share price over the past few months. But when you look at the PE ratio, 33, that is a 5-year low. So this company hasn't been this cheap for 5 years, since 2017. Same is true with the price to operating cash flow. So the question is the overall negative sentiment in PayPal and the market leading to some good value with this company? And if I had a look at the PE ratio, price operating cash flow, without looking at the chart, I'd say an all-in target for this company is $120. But the share price fell through that on the most recent trading day on the 11th of February. So I've pushed my all-in target back to $80, simply because this overall negative sentiment, I think, could continue and drive that share price down. And the share price gets to $80, which was the low during the COVID-19 financial panic, that would be a really good time to take a position in this company. Now, that's on the assumption that nothing too seriously is happening with this company, no structural problems with the business model, anything like that. So I'd have to read about what caused these significant drops in share price over the past few months. So right now, PayPal does look really attractive. That's all I have for this market sell-off hit list. I've shown you 6 companies on the Nasdaq that are the first 6 companies onto my hit list. And all I'm doing is waiting for the share price of these companies to get to my target price. Now, just because they might get to my target price doesn't mean I'll take a position, because it also depends on sentiment, as we're seeing with PayPal. If there's overall negative sentiment in the company and the market, we should just remain patient, because share price could fall quite a bit below my target prices, and I'll just wait for a bit of a shift in the sentiment for that negative sentiment to wane away. So if you do have any questions about the companies on this list, about my hit list, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.